Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Hey, Vivek, what a day, right? We are seeing fourth consecutive day of gains for the Nifty, very close to that 26,000 mark. The midcaps are doing well, hit that record high level today, and Bank Nifty gave it some company too, and a lot of results which are still trickling in. We are getting the reactions now.
That's right. Good afternoon, Sonal. Results coming in thick and fast. Last couple of days, as far as the results for Q2 will stop coming in. But we have a lot lined up on the show, some important corporate conversations as well. So let's start off with the top headlines. Stocks marginally off the day's high. Financials right. Sharp dip in consumer inflation. Pharma and metals also notch up gains, while FMCG and PSU banks drag. Midcaps relatively lag.
Biocon surges in trade as the company explores merger with Biocon Biologics. Management tells CNBC-TV18 that merger will likely be announced in calendar year 25 itself. Reports estimate merger size of $4.5 billion.
Strong Q2 numbers boost data patterns. Revenue sees a rise of 3.4 times, while EBITDA doubles. Margins, however, comes under pressure.
Endurance Technologies under pressure despite steady numbers. Street disappointed as the margins contracted in the quarter gone by. All right, those are the top headlines and individual names on our radar. But the corporate conversation that we'll have now is with Insecticides India. It is the first management on the show reported a muted set. Revenue growth was weak. We are now joined by Rajesh Agrawal, who is the MD at the company, to take a few questions. The stock, though, has recovered sharply from the day's low. Just to give you some perspective, revenue growth has been muted at 2%. The gross profit is up 11%. EBITDA is flat on a YOY basis, and net profit is down 4% on a YOY basis. Mr. Agrawal, good afternoon. Thank you so much for joining in. You know, revenue growth has been muted, just 2% growth this time. In quarter one, it was 5%. You have a full year guidance of 10% plus growth. You stick to that guidance. What makes you confident of that? And what is happening so far with the macros and individually the company as well?
The company is performing good. The things are a little difficult in the market. Why? Because ours is the industry which gets the first impact of the rains. So the rain god was not that kind. The rains started early this year. First quarter looked very good, but at the end of the quarter there was a dry spell, and that continued even till in the second quarter for about 18-19 days. But after that, what happened? There was a continuous rainfall, and it didn't stop throughout the quarter. So the area was very, very bad. So being wet, farmer could not enter the farms for the treatments. The sprays got delayed, and ultimately due to this, there was a deep impact on many products. The sale could not happen in the quarter. So for the performance of the company, I would say, please don't judge us by one quarter or two quarter. Yes, our yearly target is double-digit growth. So we are still confident that we'll make a recovery in the second half of this year, and our year will be positive both in top line and the bottom line, because our focus products will see some good sales during the second quarter, because this water availability is giving the benefit to the farmer, and Rabi sowing is expected to be very good, and we are very, very confident that we'll definitely make a recovery.
Okay, Mr. Agarwal, we take that point completely. Monsoon impacted a whole host of sectors, yours especially so, like you just highlighted. But can you quantify the impact as far as FY26 is concerned? A 10% revenue growth for FY26 is what you had guided for. You had also guided for double-digit growth guidance in the premium products as well. So now, are you revising or trimming that lower, formally?
I'll not revise the target of the premium products. There can be a little impact of 1-2% plus minus on the total growth, but still I'm confident that we'll land up near that.
Okay. What about the inventory levels? Have they normalized now? What's happening with the balance sheet size? Because you did indicate that there have been issues. So what's happening with the inventory? What does it mean for your working capital days?
If we talk about the market, then we have cleared up the inventories from the market, and we have given the stocks for the new season. So that way market is clear, and they are working on the new crops which are going to come. Yes, we had the goods return, but that goods return whatever was there in the Q2, it is also a normal trend that after the close of the season, whatever is left over has to be lifted by the companies, and we in particular lift that back because we don't want our stocks, unsold stocks lying in the market, because that creates unnecessary fuss in the market. So we lift that back. So this year, yes, the goods return was little higher, and the payment position was also little weaker, and that is one reason that the overall situation did not look that good, and our finance costs increased a little. But I believe that the H2 is the collection period when we collect more than our sales. So we'll make that recovery also, and the situation will normalize. As regarding the inventory, yes, inventory levels are little high to the tune of 700. By the end of the year, we can expect it around 800 crores, because the new season built up is going to come, because we have to prepare ourselves for the next Kharif. So, and when we are manufacturing a lot of AIs, and new AIs will also be added in Dahej, the new plant will also start working in full swing. So we have to arrange the raw materials and make the products. So you can the inventory level temporarily will be a little higher.
So, Mr. Agrawal, inventory levels will be high. You had 172 working capital days in FY25. That was elevated from the earlier levels that you've seen. FY26 will see more pressure. Can you, if you have any guidance in mind for working capital this time?
I'll not give the guidance actually for FY26, but I'll say that there will be improvement, because once the more sale is going to happen than the previous year, because we are expecting a decent growth in Q2. So in this quarter also we are expecting growth. So once that will happen, then figures will automatically improve.
Okay, Mr. Agarwal, last time when you joined us, we spoke about the potential export opportunities for bioproducts through Nissan. You also highlighted that your target is to scale exports towards the 200 crore, target. Now, where do we stand on that currently? FY26, will it be a year of reset where you may see a slightly lower sales?
Exports is increasing. The international markets have stabilized. In this quarter, the export figure is good, and the order book, what we have for the next 6 months, is also looking very attractive. So we'll definitely, across last year, the exports are going to increase by at least 50% during this year. That is the vision. And in future, yes, we'll do more exports. We are, some CRAM business is also going to start soon. So we are working with some Japanese companies and some other international companies. So that business is going to happen in next calendar year.
All right, we take that point. Mr. Agrawal, a lot more questions, but we are out of time for today. Thank you so much for joining in and answering on the outlook of the business. But with that, we'll slip into a short break. When we come back, we'll get to excerpts of our conversation with Tata Steel management of their Q2 numbers and more. Stay tuned for that.
Welcome back to Mid-Cap Radar. Well, the market continues to scale new highs, especially when you're looking at some of the large-cap names. Reliance Industries near the day's highest point. Even a name like ICICI Bank doing very well in the session. And the other stock, one especially large from the capital goods space, is L&T near the day's high as well. But moving on, Tata Steel reported a good set of Q2 numbers, led by the India business as well as the European business that came in line. In fact, my colleague Nigel D'Souza spoke to TV Narendran, CEO and MD of Tata Steel, and began by asking about the demand and the impact of the GST rate cuts.
We've had a decent quarter. The domestic demand has been strong. If you really look at it on a year-on-year basis, the steel consumption has grown by about 10 to 12% per year, which is strong. The challenge has always been the prices in the market, which have not been great. There's pressure because of international prices, export opportunities not existing. There's pressure because there's a lot of supply coming on stream, including us. Hence, there have been generally margin pressures in the market. But overall demand has been strong. We've not seen a GST impact in that sense of the term, because firstly, the steel industry is not so directly impacted. It's more our customers who are impacted. But that did not have a material impact on our offtake.
All right, that brings me to the next question with regard to pricing. We have been talking about this for a while. Indian steel, if you compare it with imported steel, is at a big discount. So there are hopes, for a while that there's going to be a price increase. Yeah. The monsoon got over a month or so ago, and yet we haven't heard about that price increase.
Yeah.
What are we waiting for? Is supply too much? Because this supply is likely to continue. You, as well as some of your peers, will continue producing more. And if demand is strong enough, then we should ideally see a price increase. Or do you think prices will continue to stay at current levels?
I think, Nigel, the challenge is, like I said, the international markets are not really attractive because of the fact that China is still selling 10 million tons of steel a month. May not be in India, but they're selling it all over the place at prices at which they themselves don't make money, right? So as a consequence, the export markets are no longer an attractive option. Whereas at one stage, India used to export 1.5 million tons a month. So that volume is coming into the domestic market because hardly any exports is going out of India. And that's adding to the pressure, particularly in months like September, October, when anyway the offtake is a bit low because of monsoons, because of workers going back for festivals and all that. So inventory builds up. There's pressure then on the steel producers to drop prices a bit, and which is what has been happening over the last 2-3 months. So we are obviously hoping and expecting that prices will go up in the second half of the year because that's normally a better part of the year for steel consumption. The festivals would be behind us. Elections would be behind us.
Let's talk about the cost side then. Cost of coking coal cost, how much lower was it in the second quarter? If you compare it with the first quarter, you could break it up geography-wise as well. And for quarter three, how is it likely to look?
So I think we had guided that coking coal prices will be about $10 lower from a consumption point of view in Q2 compared to Q3. And it was pretty much as per guidance. It's relevant only for Netherlands and India because we've closed the coking plants in the UK. And for the next quarter, again, Netherlands will see another $5 to $7 drop. India will see a $5 to $7 increase because Netherlands typically holds more stock because they have, their supply chain is a bit longer.
Okay, let's talk about pricing then in the European markets. There have been those restrictions that have been put in and quotas have been cut as well, which in turn should reflect in positive pricing. So tell us in Europe, how is pricing shaping up? And also, in the coming months, CBAM is likely to be implemented in the European markets. That's what could give a further fillip. So how do you see pricing environment?
So if you look at Europe, we are positive on the pricing. May not be for this quarter, but certainly from January, because the announcements that the European EU has made on quotas is welcome. Basically, they're going to cut the quotas by 50% and have a 50% duty on any volumes which come in excess of the quotas. So that's positive, and I think steel prices have started going up. It's a good time for us to also negotiate our annual contracts because this is the time when we negotiate annual contracts for next year. So I'm positive about steel prices in Europe from January. In this quarter, we are likely to see a drop simply because we will see the impact of the US trade issues. We did manage to get some of our volumes through in the last 2 quarters, but now we are impacted by the duties. Of course, our customers are bearing some of the costs in the US, but some of the costs are coming back to us, and some of the volumes that we've lost to the US being diverted to other markets are also not helping realization. So our guidance on prices for Q3 compared to Q2 in Europe, Netherlands particularly, is about 30 euros lower in Q3 compared to Q2. In India, it's about 1,500 rupees lower for Q3 over Q2. In UK, we expect it to be flat, though UK has a lot of challenges because UK doesn't have the protection that EU has.
Okay, let's focus on profitability then. India EBITDA per ton was looking quite good, given that pricing will be soft, but you'll have operating leverage, that will play out. Though input cost at India as well will be relatively high, as you told us, because, the cost of coking coal. So for India, Netherlands, as well as UK, how do you see things panning out in terms of an EBITDA per ton directionally? And when does UK turn into the black? Quarter 4?
So as far as margins are concerned, we will see some margin compression in India because of lower prices and higher coking coal costs. But we will also have more volumes in India compared to Q2. We expect Q3 to have about 500,000 tons more sales than in Q2 in India. So that's a positive for India. But there will be margin compression in India for Q3 compared to Q2. In terms of Netherlands, again, there will be some margin compression, but not as much because we are also getting some benefits on electricity and other costs. UK also, we expect things to be a bit flat. But UK, the larger issue is the UK government has still not adjusted the quotas like EU has done. So as a consequence, for many of the products that we produce in the UK, the quotas are greater than the demand for that product in the UK, and that's causing us a problem. talking to the government to see what is the help we can get there.
Yeah.
So that's why UK is still in the red. Q4, we will not be in the black. We hope to keep reducing the losses in the UK. If you saw this quarter, the losses in UK were half of what it was last year, the same quarter, and last year, the same quarter, the prices were much better.
Okay.
So the prices have dropped more than we had thought. Our actions have helped to make sure that the losses are less,
Okay.
but we are not yet in the black, and we hope to get in the black in the next few quarters.
Next few quarters. So in the first half of FY27 should possibly be in the black?
We need some support from the government on some of the actions that we've requested, and if so, then we should be in the positive.
All right. And debt went up a little bit. That's because of working capital. That will align itself?
Yeah, so it's in some sense what was part of our plan. We had planned to bring down the debt by the end of the year. Middle of the year, we had expected it to go up because a lot of the Kalinganagar payments are being made. The facilities have been commissioned. The ramp up is still happening. So the benefits that should accrue to us are still accruing. So I think it's temporary. We think the debt is largely under control in terms of, if you look at the net debt to EBITDA, we are below 3. And, we will keep managing it very tightly going forward.
All right, that's the word coming in from Tata Steel. The stock has recovered from the lows of the day as well. We'll slip into a short break now. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned for that.
Welcome back to Mid-Cap Radar. Well, it's the last week as far as Q2 results are concerned, and earnings are coming in thick and fast. Just a couple of minutes ago, you saw the results of Alchem Labs on your screen. While the results were a beat to estimates, it's going to be important to see, whether this particular strong EBITDA margin trajectory can continue in Q2. Post the results, the stock now trading near the day's lowest point. So that's going to be an important stock to track. The other stock that's doing very well in the session today is Vodafone Idea. It's seeing continued buying, especially post an encouraging Q2 where losses actually narrowed on a year-on-year basis. That particular stock near the day's highest point, almost touching the 11 rupee per mark. Alchem continues to slip. The other stock that yesterday did very well, but today seeing a bit of a sell-off, is CDSL. Now, that particular stock too is now down 1% and near the day's lowest point. And in fact, in the last 15 minutes of the session, what we're actually witnessing is a bit of a deterioration as far as the advanced decline ratio is concerned. But with that, it's all the time we have on this edition of Mid-Cap Radar. MF Corner when we return.